Coming up, we take a look at the business of football, how investors have reacted to the escalation of the conflict in the Middle East, and US inflation rises. All that and more next. Everyone, welcome to the SBS On the Money podcast for this Thursday, the 11th of June, 2026, a day where the Australian share market fell, the ASX 200 down 0.23%. We'll have the details with Henry Jennings from Markets today soon, including what he is telling his clients. But first, there is just one short sleep to go until the start of the 2026 FIFA World Cup. But as the world's most popular sport, with double the number of global fans than cricket, according to FIFA, it's hoped the winners of the tournament extend beyond the football field and into the economy. For a look at the business of football, I spoke with Mark Andersen, co-head Global Asset Allocation at UBS GWM CIO. Okay, Mark, with the FIFA World Cup about to start, just how big is the business of football and what role do you think the FIFA World Cup plays in this?
So football is the biggest sports that we have with an estimated 5 billion fans around the world. And it's also the sports that generates the biggest revenue. In the context of that, the World Cup is also the biggest sporting event that we know, engaging around 6 billion people worldwide, which is an extraordinary 3/4 of this world's population. And that's something that's making it both a cultural and an economic phenomenon. So when we look at the World Cup specifically, on some estimates, we're likely to generate around 40 billion of economic value, which is equivalent to the country, Denmark, where I'm from, what's being produced during those 5 weeks of the World Cup.
What about the economics of sport, especially football? How are they changing in terms of, I guess, how we're watching it and the growing parts of the code?
So when I was growing up, watching football was the 90 minutes on a Saturday afternoon, watching a Premier League game or the like. But today, football is being consumed way beyond those 90 minutes. So when you look at younger fans, most of football is actually being consumed on social media. It's in shorter clips. And guess what? It's often during working hours as well. So there you go. But what this means is that there is sort of a lot more regular engagement, especially these younger fans. They also want content beyond just the game. They want to see what the athletes are doing. They want to follow their teams on the training pitch, etc. And that creates a lot of potential for commercial value through advertisement, etc. Another very important trend is what we see in women's football. So during the 2023 World Cup, we had almost 2 billion people following that tournament. And at the same extent, we're seeing significant growth in revenues around women's sports. On top of it, the fan base that's watching women's football is also very attractive. It's typically a higher consuming segment, slightly more educated than its male counterpart, it turns out. And that is something that makes it a very attractive growth area in football.
What about sport as an asset class more broadly? What do investors need to be aware of?
So sports as an asset class is definitely growing. And when we watch how it's been performing over the last couple of decades, it's done extremely well in terms of returns. So we've seen it outperforming major global equity indices if you're invested into sports. And at the same time, it has done so with very little correlation to other traditional asset classes. It basically means that we are very likely to consume sports also in times of economic disarray where you might be losing your job. You're still following your team, you're still consuming within football. So it makes it attractive from several metrics. When we look forward in terms of football in particular, we also see that the fan base is very geographically diverse. It's exposed to high growth areas such as Asia, Latin America, Middle East, where people are likely to use still a bigger part of their wallet and spending on things such as sports and football in particular. So we do think that there is a great potential for investors to increase their exposure to sports. That's both through listed equities, but it's also through different funds that can be private equity, private debt. Imagine investing into both clubs, leagues, financing of stadiums, etc.
That is Mark Andersen there from UBS GWM CIO. Now, while there are 5 billion fans globally, those attending may have some financial gripes. I spoke with UTS Chief Economist Tim Harcourt to find out more. Okay, Tim, there's a lot of excitement about the FIFA World Cup, but also a bit of concern about the price of tickets, as we know. Why is that?
Well, there's this process called dynamic pricing that is quite common in America, which is based on peak demand. So if there's peak demand, they put the price up straight away. And traditional soccer fans, football fans are not used to that, even though American sports fans are. So dynamic pricing means you can adjust it according to peak demand and supply. So it's a bit like, airfares, when airfares are made cheaper and everyone jumps on them, and then, as we saw, prices go up if there's great demand. So in the United States, because there's so many sports, you can actually buy tickets according to, when they're surging or not. And most people who go to the World Cup expect a flat rate for their tickets. And when they're planning to go from Portugal or Brazil or whatever, it's a big undertaking. So they're not really used to this idea that the prices can be adjusted.
The World Cup is obviously an enormous undertaking, but is it now too expensive to host? And is that perhaps why we're seeing it being shared amongst a number of countries this time round?
Yeah, it certainly helps to pass it around a few countries. I mean, Brazil had a huge undertaking and they took on the Olympics as well at the same time, and it really left them with a lot of sort of white elephant stadiums. But the good thing about North America, particularly the United States, is they've already built their stadiums, they've already built the infrastructure, and Mexico's held the World Cup twice, so they've got the infrastructure in place as well. That makes it a lot less risky if you've already got the stadiums.
What about the economic benefit, right? Is it better to win or better to host the FIFA World Cup?
Believe it or not, most economists say that it's probably better to host it. If you win it, there's a bit of a market reaction, a bit of a psychological boost, but it sort of goes away in 3 months. While hosting, you get a few more benefits in terms of tourism. But at the end of the day, if your economy is in recession, then the World Cup won't save it. It'll just make people feel a little bit better for at least a month or so.
That's Tim Harcourt there from UTS. Let's take a look at the Australian share market now, which fell. The S&P ASX 200 off by 0.23%. That's as the war intensified in the Middle East and as inflation in the US rose to 4.2%. Tech stocks tumbled while energy fell. And to go through the day's market action, including a look at tomorrow's SpaceX listing, I spoke with Henry Jennings from Markets Today. Henry, so it would appear the market has turned along with investor sentiment because over the past 5 days, the ASX 200, for example, is down around 1.5%. In the US, the S&P 500 is off 3.3%. The tech-based NASDAQ down 2%. Gold is down 6%. And the Aussie dollar is at a 2-month low against the US. What's happened?
Well, I guess there's a couple of things that have happened. I guess SpaceX has happened, and the US markets have been weak on the back of that. We're yet to see it list, of course, but there does seem to be some rotation out of some names into cash so that they can afford to apply for the SpaceX. And here we've had a lot of pressure on resource stocks. It is a tricky time of year. It's always tax time, and there's tax loss selling in some resources, and gold has really fallen out of bed. And that's primarily on the fact that the US is no longer looking at maybe any rate cuts, but the rhetoric has now sort of flipped over towards rate hikes in the US. Their economy is still going pretty strong. So that's really affected gold. It's affected other commodities as well, put in tax loss selling. And we had a rotation here as well, out of banks, out of the big resources like BHP and Rio and the gold sector, into stocks which have been somewhat under pressure this year, things like CSL, which has had a bit of a renaissance in the last week or so. So there is some rotation going on. It's not all bleak, and even today, we were down 100 points at its worst. We're now up slightly, 2 points. So, there's clearly a lot of things happening at the moment, Ricardo.
Inflation in the US has hit a 3-year high of 4.2%.
Yeah.
Donald Trump says he loves it. but it will fall like a rock as the war ends. So that's what he said. But isn't that the big question? When the war ends, when will that happen? Isn't that the question that investors are grappling with? Because as I mentioned earlier, all those indices and market indicators that fell, we've seen the oil price climb this week, though.
Yep, we have, but not as high as you would have thought, given the kinetic involvement now of the US. They call it kinetic when it's sort of missile strikes. So it's not gone as high as some would have thought. And what's happened is oil has kind of found its way around the Gulf of Hormuz through various other alternatives. So that has been some good news there. But inflation in the US, 4.2%, that is double the 2% that the Fed is targeting. And we've also got a Fed meeting next week, the first one for Kevin Warsh at the helm. So that is going to be interesting in itself. So there's a lot going on, as I say, Ricardo, what with SpaceX, a new Fed head and a meeting next week. But certainly, Donald Trump saying, I love inflation. Well, I don't think his voters love inflation because his opinion polls are not looking too good. And interestingly, somebody clever has added this up. Donald Trump has announced that they are close to ending the war 38 times. That's quite extraordinary.
You mentioned SpaceX. We've got the IPO coming up at the weekend. Given the hype and the launch of a few ETFs in the sector as well, what do you make of the space economy and the space trade?
Well, it's obviously getting bigger, very much bigger. It's all a question of how much it costs to launch a kilogram of stuff into space, and that has fallen dramatically. I think it was sort of $54,000 a kilogram in the NASA days in the 70s, and now it's about $3,000 a kilo. So the lower the cost, the more they can stick up there, the more they can monetize space with moon bases, etc. But it's not without risks, as we saw with Jeff Bezos's latest rocket blew up on the launch pad. SpaceX is by far and away the cheapest and the most advanced in terms of rockets, and the space is only going to get bigger in some respects with the race, I guess, to put data centers on the moon. And there's a lot of blue sky and black space built into this SpaceX valuation, that's for sure. It is a bit like pin the tail on the donkey in terms of 1.77 billion is the valuation. It's hard to get there, but there's a lot of people that believe, and if you believe in Musk, then we should see it go okay. It will be certainly interesting to see how it goes, that is for sure. And will be a little bit of a barometer of the risk appetite out there.
And finally, in wrapping up, what are you telling your clients right now, and where do you see the opportunities for investors?
Well, we've been still quite long in terms of technology, and we have stuck to it, although it is a little bit nervous Nelly time. I think it's still a little bit nervous Nelly time. We could go into a bit of a stasis this summer in the Northern Hemisphere. You've got the World Cup, you've got midterms coming up, and still no solution to the Gulf War. So we could sort of go sideways, but our market, although it's felt weak, it has staged some pretty impressive comebacks. So there is some underlying strength out there, although it may not be in the stocks that people thought that have run pretty hard. So it's time to be cautious, but I don't think it's time for panic just yet.
That's Henry Jennings there from Marcus Today, and he wraps up the podcast for this Thursday. Give it a like, a review, and subscribe if you enjoy it. Don't forget you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.